now the analysts on Wall Street are all projecting, or the average projection is for the S&P 500 to go to 6,700. That's 14% higher than when we're recording this. Now, first off, analysts are typically very, very bearish. They're never optimistic at the same time. I just feel the contrarian in me is telling me that, markets aren't going to do what these analysts are telling you it's going to do. Call me a cynic, Bob.
Well, okay. Hey, Rye, you're a cynic.
That was therapeutic. Thank you. Let's start the year now.
Okay. Well, you don't get if you don't ask. And you ask. So
I'm going to give a shout out to our friend Mike Turgeon, who coined that phrase. If you don't ask, you don't get, Mikey. I love that.
But you know what, guys? I mean, it's when you look at the biggest fear any investor has is that I'm going to put money in the market, it's going to go down. Well, bear markets coincide with recessions. And there's only been 6 recessions since I've been in the business, and only 6 bear markets. So here's the biggest problem with that. We just made fun of economists for the last 2 years who predicted a recession that never showed up. So if you can't predict a recession, how are you going to predict the bear market?
Or the booming economy, right? And I think the economy is booming. But I thought, you know what? These analysts aren't very good. But what if everyone here in this room, well, I guess virtual rooms too, gave their take on what's going to happen in this year? So I thought it'd be interesting to see what everyone's projections are. And, whoever gets closest to what actually happens this year come December gets a Bob Payne mug, a master planner mug. What do you think?
What are you actually asking for? A S&P projection, a Dow projection?
Yeah. And I think the bottom line is it's kind of hard not to feel like the economy is going to boom this year, right? I mean, it just seems like everything is in favor of economic growth. Whether it's deregulation apparently is coming, we've got tax breaks that are apparently coming. It just seems like the overall environment is ripe for more economic growth. And I actually don't think that's incorrect. But I think the one problem is when you have economic growth or more economic growth, that can also be very inflationary. And it just seems like a lot of these policies coming down the pipeline say more inflation, not less inflation.
And that's the big question, is at what point will the inflation be so high that consumers are going to stop spending or start putting more on credit cards and get more in debt? And I think that's what people have thought was going to happen for the last several years, which hasn't been happening, which is good. I mean, at least on the larger general consumer. But that's the question, is if inflation keeps going up, can the consumer keep spending? I think that's one of the big risks that we have going into next year.
Well, I think a lot of it has to do with the half of the net worth in this country is in the hands of the baby boomers. And they know they have less time to spend than more time. And I don't think they're going to stop. I think that they're enjoying their lives. They're going out to dinner. They're traveling. I mean, sometimes you go and book a trip. It's hard to get. You try and book a reservation, forget about it. We're in season in Florida, so I think consumption is going to continue to be strong.
Yeah, I can attest to that. I hung out with you and Mom over Thanksgiving, and I don't think we ate dinner one night. I think we were out to dinner every single night with all your friends.
It's interesting you bring that up too, because I think that is what's happening. Is there's 2 very different consumers, right? There are people who are really hurting with inflation. It's especially like your younger consumers, those who want to buy a first house. You're now looking at 7% interest rates. But then you have your baby boomers who either have no mortgages or mortgages less than 4%. These rates going up and inflation isn't as much of an impact to that population as it is other people. So I think that's what's really interesting, is you're seeing one side of this, and clearly it's affecting consumers different ways. But when you look at the aggregate, people are still spending. And that's what the question is does that continue?
Well, I'll tell you my observation, guys, and this is why it's so hard for investors, right? All year we've been telling investors on this podcast, about why things were so good. And now when the market's gone up for 2 years, remember 2 years ago, everybody was negative. Sentiment was extremely negative. Nobody wanted to be invested. And now the things that where their portfolio's up and things are really looking good, the numbers are coming out good and the market's going down, it's counterintuitive, because if you go back and look at where the sentiment was, right, at how bullish people were, how enthusiastic they were to embrace risk, the market's been going down since then. It's the market does whatever it has to do to confuse the majority opinion of the time. And we're seeing it in action right now. So I think we're setting up for a gigantic buying opportunity.
Well, I don't know. I think the market could just keep going higher here too. I don't know if you're going to get this quote unquote buying opportunity. Maybe it's always a buying opportunity, but I think, you know what? Those prognosticators like to give their prognostications. I'm going to give you mine. I've been trying to give this all episode. I think the problem here is everything we're talking about, more economic growth, more inflation. The S&P 500 is not reflective of that, right? At this point, we talk about this a lot. It's driven by the 7 Magnificent 7 stocks. They're technology, AI related. That's not necessarily a litmus test for what's going on in the overall economy, where it's not a representation of that. And I think this is why you want to spread out your exposure. But what I think is going to happen here, and you guys, at the end of the year, we can look back and say, Ryan, you're so smart. Or, Ryan, your predictions are horrible. But I think, your big risk here is, and we talked about this a lot, is just a magnificent melt up in those areas of the market that aren't reflective of the overall economy. And that's just the S&P 500, those mega cap names, Bitcoin, crypto. It's just going to go higher and higher here, setting up for a huge meltdown. And I think that's the biggest risk right now. And I think that's where investors are missing the big point here of a booming economy.
All right. I don't think you're just only smart. I also think you're handsome. And I think that's a great insight.
Keep going, Bob.
And I
Keep
think
going.
as a result of that, what we're going to see over the course of this year, I think we're going to see small caps, small companies outperform large. I think we're going to see value outperform growth. And I think we're going to see non-US stocks outperform US. It's a reversion to the mean. It happens in all cycles. I think we're due.
Yeah, and I think what's interesting is when you hear a lot of these analysts talk about where they think the S&P 500 is going to end up at the end of the year, you have to remember that, more than a third of the S&P 500 is like 10 companies right now?
Yes, that sounds about right. Yep.
Yeah, you got to remember about a third of the S&P 500 is just 10 companies. So when you're taking a litmus of what the S&P 500 is, you're not looking at the overall stock markets. You're mainly looking at that Magnificent Seven and what that's going to do. And I think that's the question, is if those few things don't outperform, but a lot of other things do well, you could see maybe the S&P, those 500 companies don't meet their targets, but a lot of other things could outperform. I think that's what Ryan's saying here is, yeah, maybe we don't hit those targets, but there's a lot of areas of opportunities elsewhere.
Well, at some point, the metrics just get silly. Look at Tesla, for instance, right? Tesla sold under 2 million cars. I know it's a technology company, et cetera, et cetera. I've heard all that, but at the end of the day, they make the revenue to one thing, selling cars. It's worth 1.3 trillion or somewhere around that. Meanwhile, Toyota, which sold more cars than any other automotive company in the world last year at like over 10 million cars, trades at a market cap at something like 300 billion. So at some point here, you've got to say, okay, I get there might be a small premium or a little premium to be Tesla, but that's just insane, right? But the insanity can go on for a long time.
You can buy Tesla at 128 times earnings, or you can buy into some great foreign stocks, which sells at a much less multiple, at 10 times earnings or 12 times earnings, and also pays a dividend.
Last time I looked, Bob drives a Porsche.
See, Ryan, what I think you fail to realize is that the CEO of Toyota Motors isn't working in the Trump administration in Washington.
Wait a minute, Bob. There's no conflict of interest there. Look the other way. There's no conflict of interest. Clearly, there's no conflict. But you're influencing the government, not elected, and you're selling to the government. No conflict of interest.
But I think the other thing is, 2024 was all about AI all the time, right? It was all AI. And I think that AI does change everything. I mean, I went through a cycle like this, 30 years ago with the internet. And, the internet will change everything is what I heard every single day in every article I read. And it did. And that's the thing that, I think investors have to grasp is that AI is going to improve the productivity and the profit margins of every publicly traded company in the world. So if you can buy future earnings, like you're saying, Ryan, not pay 120 times, those earnings. I mean, you want to be a bargain hunter. I don't know who likes to overpay. There's two things in life I found that people don't like: overpaying and being overcharged. And the problem is a lot of investors, they do it to themselves.
Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, brokerage product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. All right, it's the tipping point. This is where we pinpoint the pain point. Of course, that's Payne, having the biggest impact on your wealth right now. And guys, it's a new year, new Chris. Well, maybe it's the same old Chris. I'm not sure.
Well, you're wearing the same old sweater.
It's a classic, Chris. We call it a classic where I come from. But I think we could talk a little bit about where we see the best investment opportunities for 2025. The one thing that happens in investing is the dynamics are always changing. And, this is hopefully why we have a job. I think this is why we have a job is, really thinking about how you want to construct your portfolio, not just for the next couple months, but really for the next couple years. And the dynamics are changing a lot. And I think, repositioning the way your portfolio looks for the next 10 years should look different than the last 10 years.
So what you're saying, Rye, is that the right trade is not the obvious trade?
Well, it could be short term. Bob, you and I were talking about this, but typically what did well the previous year tends to have momentum going into the next year.
I've always been optimistic, and it's not because I'm a born optimist. It has to do with looking at the numbers, and the markets have an upward bias, right? They always make new highs over time. I want you to own the S&P. You have to own that, but you have to own everything else. But you have to have your own personal asset allocation for you to be able to stay invested, right? Because I guarantee you that people that are overweighted in Bitcoin and Nvidia and Meta are going to panic and sell at some point.
Well, Bob, I like to know that magic date when that happens. But I think that's the problem. If you think about it, it's just that, okay, whatever's working could continue to work. But as an investor, your bigger risk is you concentrate in that one area, right? And we see this all the time. I mean, we look at probably more portfolios than anybody a month. And everybody has their money in the S&P 500, the Magnificent Seven trade. And it's overweighting the overweight, as Bob likes to say, which again, that could continue to work for quite a while here. But at some point, we know things change. And, the one thing we know is dynamics are going to change. We don't know when they're going to change, but you got to be prepared for it ahead of time.
Yeah, and it's interesting because I think a lot of people focus on the Magnificent Seven, right? That was the one thing that did really well. I mean, not just last year, the last couple of years. And everyone's saying, okay, should I be in or out of the Magnificent Seven at this point? Should I look at other opportunities? And I don't think that has to be a yes or no answer. Like, I think the way we look at it is you still want to own these things. I don't think your Apples and your Googles are going anywhere. I just don't know if they're going to outperform to the same magnitude that they have over the last several years. I think that's where, with all of your hard-earned cash, you want to start to look at some of these areas that people are still down on right now and probably have a lot of opportunities as we look forward. So you just want to make sure you're spreading your money out because we might see very different areas of the market start to outperform this year.
Yeah, I agree, Courtney. I mean, if you think about things like utilities, which did really well last year, but also still pretty undervalued and pays like a 4% dividend.
Yeah, well, I think you hit the nail on the head. It's about risk management. And the problem is when you're in a big booming bull market, risk management becomes, well, that's hurting my performance because I don't have more money in what's hot right now. I don't have more money in crypto or in Nvidia. But really, the whole idea of risk management is what we're really saying is at some point the party stops. Unfortunately, we don't know when the party stops, but when it does, you don't want to have all your money concentrated in the same place. And that's really hard to see in a big booming bull market, in my opinion.
Well, first of all, guys, the party never stops. It only takes a pause. And, the beauty of it is there are two absolutes. The absolutes are time passes and markets operate. And it doesn't care what you think or how you feel. So, and I think the other absolute is you don't have to outperform, right? I've been doing this for 50 years, as Chris said. At least my hair's been participating. But, I've been running the A to B strategy for folks for 50 years, and they achieved all their financial goals without outperforming.
Yeah, it's a false prophet. It is a false prophet. And Bob, you're a typical baby boomer saying the party never stops, by the way. The most baby boomer thing you could possibly say. But what I think it comes down to is when you start looking ahead, is we know that whatever's performing the best right now doesn't last forever. It never does. And we start looking at the fact that the 10-year treasury now is at 4.7%. What is that telling you? That inflation is probably not going away, even though the Fed told us it was going away. So you start asking yourself, okay, under that scenario, do I have something in my portfolio that covers me? And we know traditionally, artificial intelligence tech stocks don't typically do that well when you have a high inflationary environment. So it's just like, you got to think about every scenario that can happen. And I think most investors aren't doing that right now.
Yeah, I can attest to that. I mean, so many phone calls I had in the last quarter of last year was like, it's not about are we making money? It's about should we be making more money? Should we be invested in more of these things that are going up more than the, steady portfolio that you have me in?
Well, it's kind of like the same sentiment 2 years ago, Chris, when the market went down, 20% in 2022. It's now, should we not be losing money, or should we not be invested at all while the market's going down? I mean, it's just that short-term thinking, that short-term bias that destroys people and their investment strategies.
Yeah, I agree, Dad. And it's funny. One of the last calls I took of 2024, I had somebody call me up, and I thought it was going to be one of these calls with like, "Hey, Chris, should we be invested in crypto? Should we buy Nvidia?" And the funny thing they said, "Chris, I've got all this money. Don't you think we should invest in?" And I thought they were going to say crypto, but they said Bobcoin instead. Always invest in Bobcoin.
And what do you, I'm just curious. Like, I know a lot of your clients, they're asking you sometimes, "Hey, Courtney, should we take more risk?" I mean, what's the strategy to keep people focused on their goals and not make the mistakes that they're invariably going to make if they go against your advice?
Yeah, and we've been having a lot of those conversations because this is happening, not just our clients, but just investors in general. When you see markets doing so well, you get that fear of missing out mentality, and everybody says, "Well, I want to participate in this. I want to take more risk." It's amazing how suddenly people are willing to take more downside. They say, "No, I'd rather be more in the stock markets. I know I can have downside, but like I have a feeling that things are going to do well for the next few years." So we always just try to take a step back and we'll say, okay, if you take more risk, here's what your upside is going to look like, but also here's what your downside is going to look like. Like if we're wrong and there is a bear market, here's how much risk you're taking. And ultimately that's up to the clients. But I think a lot of them have been surprised how much extra downside risk you have by trying to get that upside. And I think that's the question is, how much more is that upside going to change your life versus the downside? Because I think as human nature, that downside hits us a lot more than the upside proportionally, which is kind of interesting.
100%. And I think the 4 most dangerous words in investing are, "I have a feeling." Never invest with your feelings. And secondly, the only market in the world, the S&P 500 is up 65% the last 2 years. Only marketplace in the world where people want to buy more when the price goes up astronomically. It's crazy.
Well, you know what? Risk is subjective, and I would say subject to misery.
Wow, Chris.
Well, truth be told, guys, the economy has an upward bias. Stocks always go up over time, right? As I always say, that every dip in history has been temporary, new highs inevitable. So it's really about having your own personal strategy, one that that you understand, that you're comfortable with. And I always, I always have suspect when you sit down with a new client and they say, "Oh, Bob, whatever you think, whatever you want, just go ahead and do it." I'm going, "No, there's no way I'm going to do that." You got to fully grasp, and understand the volatility of what you're going to own. Because, quite frankly, if I can get you to your goals in a zero coupon treasury, I'm going to put you there. What you mean? Why take risk, unnecessary risk, right? People don't see these markets as having unnecessary risk. That's bull market mentality. These things are going to change, and they can change very rapidly.
And that's the most dangerous time. And I think the irony is right now, talking about positioning your portfolio for this year, is you can create a lot of what I would say almost certainties in your portfolio. Like, building a portfolio right now, there's so many stocks out there and sectors that pay a lot of income, pay a lot of dividends, that aren't the S&P 500, that aren't the Magnificent Seven. And most investors aren't allocating there, but that consistency of dividends every year, that cash flow coming in and having higher bond yields are great places to put your capital, and they trade so much cheaper. But everyone right now is, kind of mesmerized by that golden idol, that's these stocks and these crypto currencies that are going up astronomically, that they're missing probably one of the biggest opportunities of our investment lifetime.
Well, as you say, guys, things are changing. So what are some of the things that are changing, right? We're having inflation be a little more sticky than we thought. We have a Fed that's dovish in the face of a booming economy. We have profits accelerating. So if you look back historically, when rates are rising, international stocks actually outperform U.S. stocks. Value stocks outperform long duration assets like growth stocks. So you have right now, you have interest rates that are going up. We're getting what I call a bullish yield curve steepening, right? So, longer rates are going up and shorter rates are coming down. That's all that means. But, that does have an impact on what you own in your portfolio. So, I always believe in, having a strategy where you own a lot of everything. And when it's down, you buy more. I mean, what's so hard about that?
Yeah, and I last year I did somewhere in the magnitude of 180 different reviews just to go over what clients' goals are. And I would say 99% of those people needed income, not growth. So more dividends, more interest, and not so much upside.
You're not going to believe this, guys, but I went out to dinner with some retired clients last night. And they weren't able to buy I bought them dinner, but when they bought lunch for themselves that day, they didn't pay for it with relative performance. They actually used the income from your municipal bond portfolio, to pay for their meals. There's a lot of uncertainties, but there are some certainties, right? Right now we do have a healthy economy. We do have a dovish Fed. We do have a profit cycle that's accelerating. We have a friendly regime to business coming in that we're expecting tax cuts and deregulation. But what are the uncertainties, right? What are some of the uncertainties?
Yeah, and I think that's what you need to look at when you're looking into 2025. I think there's been a lot of optimism that's been priced in. So when you look at things like deregulation has been one of the biggest ones where everyone says that has got to be a good thing for businesses. When does that actually come into effect? How much is that going to impact businesses? I think is going to be one of the big questions. Are there going to be tax cuts? Is that going to affect businesses in the future? How much is inflation a problem? Clearly, that's what the bond markets are telling you right now. So I think when you look at the markets, you need to be cognizant of the fact that there are still risks out there. And I have this with our clients all the time where they say, you guys are so bullish. You guys are optimistic on the markets. We should be more in the markets, right? And though we are optimistic, we know that there's always the risks out there. And that's why you want to make sure you are balanced and you have something that will do well, even if those things that we expect to do well don't, and something else is going to come to fruition there.
Imports account for an average of 50% of all U.S. car parts, according to online automotive marketplace Cars.com. And roughly 25% of cars sold in the U.S. are assembled outside the country. I hope you like your American car, Chris.
I'm surprised Ryan knows anything about car parts. I don't think I've ever seen Ryan open the hood of a car, never mind buy a car part.
I know a Chinese car part from 2 miles away. Total assets and exchange traded funds at the end of November of last year were 11 trillion. That's up 30% year to date, a record. More and more people are putting their money in exchange traded funds.
Yeah, well, you know what? They're more tax efficient. They're cheaper. But, I got to wonder of that 11 trillion, with Apple approaching a $4 trillion market cap, how much of that is Apple?
I think a lot of that's going to the Magnificent Seven. I think you're right. Blindly buying those S&P 500 funds could be bad for your financial health at some point. We'll see.
Buyer beware. All
right, Courtney. Consumers drive the U.S. economy. They not only account for roughly 70% of U.S. GDP, but also a staggering 31.5% of overall global personal consumption, according to figures from the UN. Annual consumption levels in the U.S. are greater than the next 6 nations combined. If we do anything great in America, it's consume. Wow.
Yeah, and I think this is why you want to keep an eye on the consumer, because everybody has been just waiting for the consumer to stop spending because inflation's been so high. But you've really seen how resilient the U.S. consumer has continued to be. But that is going to be the crux of, is the economy doing well? Is it not doing well? Are people going to continue to spend or not? So that's something you need to keep your eye on.
Well, it's also like we're the world's biggest client, right? So you can see why Trump wants to renegotiate some trade deals, because it's kind of like, well, if a client comes to me and says, I want a better deal, and they're your biggest client, I hope my biggest client's not listening, we would never renegotiate the deal. Never mind. I don't want to go there. But you get what I'm saying.
All I can say, guys, if Naples is any indicator, the consumer hasn't slowed down. The consumption down here is over the top.
A lot of Bentleys and Ferraris in that garage in Naples.
Yeah, that's not a microcosm at all, Bob. That's how all Americans live.
Leading indicator, actually, right?
All right, well, another great episode, great New Year's episode for 2025. Look forward to coming up with lots of great content this year. We're going to have lots of great guests. If you like our podcast, you love our podcast, please spread the word. Give us that 5-star rating on iTunes, or if it's on Spotify, you can subscribe to our channel. If you're watching this on YouTube, you can like this episode. You can subscribe to our channel. Click that notification bell to be updated every week of all our new content. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.